Have you ever put in a lot of effort into analyzing a stock and you thought that it's a great company, but after you bought it, the price went down even 50, 80% below your purchase price, and you thought to yourself, you know what, I suck at this? Well, I've got news for you. I've sucked as well. In fact, I've sucked many times. But despite that, I still get really rich in stocks. Why? Well, let's find out in this video. So I'm here to tell you that no matter how great you are as an investor, no matter how much effort you put in to analyze a stock, looking at the fundamentals, looking at the charts, you can't win all the time. Well, at least not in the short term. So there are many companies that I have invested in the past that have sucked. Well, at least in the short term. But despite that, I still managed to grow my portfolio consistently. And let me just give you a few examples. So prior to 2020, I owned Boeing, McDonald's, Yum Brands, which I thought were great companies, and they were very good companies. But what happened in 2020? We had a pandemic, we had the 2 plane crashes from Boeing, we had the global shutdown, and my Boeing stock dropped 80%. And my McDonald's and Yum Brands and my Domino's Pizza stock, they all dropped 50% because everything was shut down and no one could go to those restaurants. But despite that, entire portfolio still grew 44% by the end of 2020. And later on, Boeing eventually recovered and I sold it all off for a profit. Yum Brands, McDonald's, Domino's Pizza, all rebounded. So they suck short term, but eventually, if you own a great company, they always come back. Sometimes later than you want, but they always come back most of the time. Then what happened in 2021? In 2021, prior to that, I owned Alibaba, I owned Tencent, I owned Ping An Insurance, many of these Chinese ETFs as well. And what happened? Suddenly, out of the blue, the Chinese government, they cracked down on tech regulation and they killed the property sector, and my Chinese stocks, Alibaba, Tencent, and all that, dropped 20, 30, and then 50%. So again, they were great companies, but there was no way I could predict all these things that happen, unless I know Xi Jinping personally, which I don't. But despite that, what happened by the end of 2021? My portfolio still grew overall up 23%, despite all those stocks that sucked. And of course, that hasn't rebounded back yet. I'm still waiting for it, and it's still in my portfolio. Have not sold a single share. And then what happened in the last 12 months? The last 12 months, my Estee Lauder stock is down 50% from the price I bought it. My Disney stock is down like about 30%. I also have a very small stake in Boston Beer that's also down almost 30%. So I've got 3, again, stocks. When I bought it, I thought they were great companies, but again, they sucked short term. But despite that, my overall portfolio is up 49.6% in this first portfolio and up 43% in the second portfolio. Again, these 3 stocks will not suck forever. Estee Lauder, Disney are great brands. Inherently, they are great businesses going through some short-term shit. Boston Beer also going through some short-term shit. So later on, they will not suck anymore. They just suck short-term. But again, even if you buy stocks that suck short-term, you can still grow your investment portfolio and your wealth consistently. So what's the secret? How do you make sure that even if some of your stock picks suck short-term, you can still build your wealth? The answer is, the secret is something really simple. It's called diversification. That's right. Don't put all your eggs in one basket. Don't go all in one stock. Because no matter how great you think the company is in the past, shit can happen. Shit can happen that sometimes there's no way you can foresee. I mean, how could I have foreseen that the Chinese government would crack down on the tech sector and great companies like Alibaba, Tencent drop 50, 80%? There's no way you could predict that. There was no way I could predict that there'll be a global pandemic, that there'll be 2 plane crashes and Boeing dropped 80%. Remember to join us for Black Market 2023, where we'll be exposing Wall Street's dirty secrets from the 17th to the 23rd of November. Pick up your free ticket right now by clicking on the link in the description below. So the only way to protect your wealth and to guarantee that your wealth will grow consistently is through smart portfolio diversification. So that basically means that when you invest, you need to divide your capital into minimum minimum at least 8 great companies. Again, they have to be great companies. Don't buy lousy companies. Don't buy, unprofitable companies. Buy 8 great companies, so that even if shit happens in the short term to 1 or 2 or even 3 of them, it doesn't matter, because the other 6 or 7 will go up and make up for that temporary decline of those 2 or 3, and your portfolio can still grow consistently, and you can sleep well at night with very little stress. I like to use this metaphor. So, would you sit on a plane with one engine? It could be a great engine made by Rolls-Royce, but I wouldn't, because anything could happen. You could get a bird strike, you could get a lightning strike, you could get a malfunction, and you're dead. But imagine if your plane had at least 8 Rolls-Royce engines, and even if 1 or 2 engines fail, they got a bird strike, lightning, your plane will still fly, right? And what's the chance that all 8 Rolls-Royce engines will fail? Again, it's like almost impossible. It's like close to 0% probability, right? So that's the whole point of a diversification. Now, I said at least 8 stocks. Can you go to more than 8 stocks? Can you go to 10, 20, 30, 40? Yeah, sure. As long as they are great companies. Don't diversify for the sake of diversification. That means just adding in stocks just to get more. That's done. You only add in if they are very high quality companies. Like, for example, in my portfolio now, I've got about 40 stocks. Now, some people wonder, isn't that like too much, 40 stocks? Well, not really. Warren Buffett's Berkshire Hathaway has got about 60 stocks. Peter Lynch, one of the greatest fund managers in history, he got an annualized return of 29% a year, where he beat the S&P 500 by a wide margin. At any point of time, Peter Lynch had an average of 1,000 stocks. Now, that's a bit too much for me, but I think 40 is pretty okay for me. Why? Some of you would know that one of the keys of my beating the market is that I only buy the top 1% of the strongest companies in the market. Now, in the overall US market, there are over 6,000 stocks. What's 1% of 6,000? 60. That's right. So as long as I've got less than 60 companies in the portfolio, I'm within the top 1% of the best companies in the market. And if you do that, you will easily beat the market by a wide margin. Now, the great thing about diversification is that if you buy at least 8 to 10 great companies, which you do your research in, even if 1 or 2 or even 3 of them suck in the short term, you will still do very, very well. You will still beat the index by a wide margin and beat over 90% of professional fund managers. So let me give you an example over here. So let's imagine that 5 years ago, you bought a portfolio of 10 stocks. And these are the stocks actually in my portfolio. It's a sample of my portfolio. So you've got like ASML, Meta, Microsoft, Alibaba, Disney, Estee Lauder, Amazon, Nvidia, Lowe's, and Apple. And let's say you bought it in equal proportion, 10% allocation each. So for example, if you have $10,000, you invest $1,000 into each one of them. Now, if you have $1,000 to invest, you invest $100 into each one of them. Nowadays, brokers like Interactive Brokers allow you to buy fractional shares. So you could literally buy $100 of ASML, even though the share price is above $100. So that allows you to diversify your capital, no matter how small your capital is. Now, when you first bought a portfolio of these 10 stocks, you thought they were all great companies. And there's no way to predict that at the end of 5 years, for example, or 3 years or 1 year, which one's going to outperform, which one's going to suck. There's no way to know until it happens. Now, from experience, I can tell you that roughly, out of 10 great companies that you buy in the short term, in the next 2, 3, 5 years, roughly about 3 of them will do really well. Roughly 3 will do really well. And then 4 to 5 of them will do well. And 2 or 3 of them will suck. Again, in the short term, the suck ones will unsuck later, but they will suck for a while, all right? And that's usually the percentages I've seen over the years. So sure enough, you can see what happened after 5 years. 3 of them do very well. Nvidia, up 700%. And ASML, up 281%. Apple, up 257%, Microsoft up 237%. So these are the four that did very well. And then you got some that did okay, right? Okay means, not too bad, slightly outperforming the S&P 500. You got Lowe's up 121%, Meta up 115%, Amazon up 61%. And then you got 2 or 3 that will suck, which you don't know until it happens, right? So Estee Lauder down 15% over that 5-year period, Disney down 26%, and Baba down 41%. Now, if you held on to all of them in a portfolio, would you have beaten the market? Would you have beaten the majority of professional fund managers? You bet. So let's take a look at the combined results. You can go to this website called Portfolio Analyzer. They will do all these statistics for you, very useful. And again, you can see if you put in your capital into 10 stocks in equal proportion, after 5 years, your portfolio would have grown to be the one in blue versus the S&P 500 in red. And after 5 years, your compounded annual growth rate would be 28% annualized growth a year, which is more than double the S&P 500. So again, what's the point? The point is that even if 30% of your portfolio sucks in the short term, you're still beating the market by 100%. Of course, the most important thing is to not just buy any 10 stocks. You have to only buy the highest quality companies. Now, if you have taken my Wealth Academy Investor Masterclass or you've taken my Value Momentum Investment course, you know that before I buy a company, it's got to pass my 7-step criteria of being a great business. For example, it's going to have high return on equity, consistent growth in revenue and profits. It's got to have a strong economic moat, high growth drivers. It's got to meet all these criteria, right? And please learn that. Don't just buy any 10 stocks. Then if you do that, then you're bloody gambling, right? This is not gambling, it's buying 10 great companies, 10 Rolls-Royce engines. So even if 1 or 2 or 3 get hit by lightning or bird strike, your plane is still flying high. Now, what if you're the greatest investor in the world? Does this still happen to great investors like Warren Buffett? Oh, you bet. Let's take a look at Buffett's Berkshire Hathaway. Now, if you look at Berkshire's performance, this is the company that's run by Warren Buffett, which he uses to make investments. Since 1980, Berkshire Hathaway has returned, my God, 170,000% return for investors. Versus if you put your money into the S&P 500, you only get 3,900% return. So Buffett's investing skills have outperformed the market by 43 times. I mean, he's the greatest investor of all. But let me ask you this question. Out of all the stocks he picked, out of all the companies he bought, did they all do well? No, right? Guess how many actually did well? Well, in his own words, in his letter to shareholders, this is what he said. He said, over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. So what he's saying is that out of all the companies that he bought, the majority of the companies actually are just average. They're not even beating the market. And it's only a few of them that are contributing to the majority of the gains of his returns. Now, how much specifically? Let's take a closer look at what he says again. He says, in 58 years of Berkshire's management, most of my capital allocation decisions have been no better than so-so. So he admits, majority of my stocks I picked didn't really do very well. Our satisfactory results have been the product of only a dozen truly good decisions. So what he's saying is that over 58 years of investing, it is only 12 stocks that he picked that contributed to the majority of the returns of his entire portfolio. Now, roughly over 58 years, Buffett has bought 210 stocks. Now, some of them are private companies, some of them are public companies, so total 210. So what's 12 out of 210? That's only 5%. So what the man is saying is that, hey dudes, only 5% of my stocks contribute to 90% or more of my great performance. Now, the problem is that you never know which is the 5%. Out of 10 stocks you buy, you don't know which one is the Nvidia. You don't know which one will be the Estee Lauder. That's why you got to buy a portfolio to find out at the end of the day. Now, if you look at Buffett's public stocks in the last 5 years, for example, the last 10 years, for example, you can see what are the stocks he owns in the public market, right? He's got Apple, he's got HP, he's got American Express, Chevron, Bank of America, Coca-Cola, Occidental Petroleum, NU, Kraft Heinz, and Paramount, right? And out of all these stocks, how many of them in the last 10 years actually beat the S&P 500? Only 1, 2, and 3. Only 3 of them beat the S&P. The rest of them sucked. Right, look at that. He's got 3 that suck big time. His Paramount is down 69%, worse than Alibaba, right? Kraft Heinz down 35%. New is down 30%. And it was his one winner, which was Apple, that contributed to again him beating the S&P 500. In the words of the great George Soros, one of the greatest investors and traders of our time, he said, it's not whether you are right or wrong that's important, because we will all be right and we'll all be wrong sometimes. We will suck once in a while. But it's how much money you make when you're right and how much you lose when you're wrong that makes a difference. You see, the great thing about investing in stocks is this. The worst thing that can happen is your stock goes to zero. I mean, that's the worst thing, right? Which means if you put in $1,000, the worst thing that can happen is you can only lose 1,000. You can't lose more than that unless you use leverage, which you should not do, right? But if you get a winner like Nvidia and Apple, ASML, and so many other winners, your $1,000 could grow and compound into $5,000, $10,000, $20,000. So that's the great thing about investing. You can have a lot of losers. It doesn't matter, because the few winners will take care of those losers and grow your wealth on top of that. Now, if you want to learn how to pick the top 1% of companies in the market and how to construct a bulletproof all-weather portfolio, I'll be talking about how to do it in the upcoming Black Market event, where we'll be exposing Wall Street's dirty secrets. That will be coming up live. It's going to be a series of live webinars from the 17th to the 23rd of November this year, Pacific time. So you can grab your free tickets by clicking on the link below in the description box below. Look for the link, click on it, grab your free tickets, and I'll see you guys there.